All right, so you've heard about the reclaimed block. You might even know how to spot it. But today, we're moving past just spotting it. We're building a rock-solid, step-by-step plan to actually trade it with confidence. Let's dive in. You know that feeling, right? You see the perfect reclaimed block painting itself on the chart. It looks beautiful, and then you just freeze. Where do I get in? Where do I put my stop loss? What's a realistic target? That hesitation, that analysis paralysis, it can cost you the entire move. Well, today, we're going to replace that uncertainty with a crystal clear, actionable plan. Okay, first things first, before we even think about entries or exits or anything else, there is one golden rule. And trust me on this, it is absolutely non-negotiable. You have got to align your trade with the higher time frame bias. Everything we're about to build is based on this one simple foundation. And look how simple this makes things. If the big picture, the higher time frame, is bullish, you're a buyer. That's it. You're only looking for buy setups. If it's bearish, well, you're a seller. End of story. Just making this one decision is like putting on noise-canceling headphones for your charts. It filters out at least half the junk and keeps you focused on the path of least resistance. So let's run with that. Let's say our higher time frame bias is bullish. The market is basically screaming, I want to go up. Our job isn't to fight it, it's just to find the smartest, highest probability spot to hop on for the ride. So here it is, the complete blueprint for buying the dip with a reclaimed block. Okay, let's walk through these steps, because each one is a crucial layer of confirmation. Step 1, bias is bullish. Check. Step 2, we spot our bullish reclaimed block, but, and this is super important, we wait for a break of structure. We need that proof the uptrend is for real. Now, 3 and 4 are all about getting a good price. We pull out our Fibonacci tool to make sure that block is sitting in what we call the discount zone. I mean, who doesn't love a sale, right? Then for step 5, we get granular. We drop down to a lower time frame to really pinpoint our entry, looking for one last little tell from the market. And finally, step 6 is pure professional risk management. We define our risk, set our stop loss, and know our target before we ever put a single dollar on the line. So that break of structure, or BOS, think of it as the market giving you a big thumbs up. It's the confirmation that says, yep, this trend has legs, and it just took out a previous high. Without that BOS, a reclaimed block is just an interesting area on the chart. With the BOS, it becomes a valid, high-probability trade setup. And what about this discount zone? It's so simple. It's just the bottom half of the last move up. Anything below that 50% line on your Fibonacci tool. The logic here is just common sense. We only want to buy when things are on sale. This little bit of patience, waiting for price to come to you, can make a massive difference in your trade's potential. Now, you might be thinking, wow, that's a lot of rules. And you're right. But here's the thing. This isn't about finding more trades. It's about finding the absolute best trades. Every single one of these rules is a filter designed to weed out the mediocre setups and leave you with only the A-plus opportunities. And this right here is what it's all about, the payoff. This example gives us a risk-to-reward ratio of over 1 to 2. So what does that actually mean? It means for every dollar you had to risk on the trade, the potential profit was more than $2. That's the power of having a structured plan and sticking to it. Okay, let's flip the chart upside down and talk about the bearish plan for selling a rally. And here's the best part. If you understood the bullish plan, you've already got this one down pat. It is a perfect mirror image of what we just went over. The logic is exactly the same, just in reverse. See, it's the same dance, just a different direction. 1, we confirm our higher time frame bias is bearish. 2, we find that bearish reclaimed block and wait for that critical break of structure to the downside. 3 and 4, we pull our fibs, but this time we're looking to sell in the premium zone. 5, we drop down to a lower time frame to nail that entry with precision. And 6, we set our stop loss just above the block and our target at the previous swing low. The playbook is identical. So the premium zone is just the flip side of the coin. It's the upper half of the most recent move down, everything above that 50% Fibonacci level. This time we're the seller. We want to get the highest price possible, right? We want to sell at a premium. It's this simple concept that stacks the odds in our favor for a short trade. And look at the potential payoff here. An incredible risk-to-reward ratio of 1 to 3.5. That means for every single dollar risked, the potential profit was $3.50. This is exactly why we are so patient. This is why we wait for all of our rules to line up perfectly, because these are the kinds of setups that can make all the difference. Okay, let's boil this all down into a quick recap. Number 1, your higher time frame bias is your compass. Never ever trade against it. Number 2, a break of structure is your green light. No BOS, no trade. It's that simple. Number 3, remember the rule of price. Buy cheap in the discount zone and sell expensive in the premium zone. And finally, use those lower timeframes to get a sniper entry. You stick to these rules and you unlock the potential for these powerful risk-to-reward opportunities. So there you have it, the complete playbook. You now have the step-by-step plan for trading reclaimed blocks, whether the market's bullish or bearish. The knowledge is officially in your hands. So the only question left is, which of these high-probability setups are you going to go hunt for first? Happy trading, and we'll see you in the next one.